I'll take you all through the updates for the last month, and then I'll also discuss the Houseview for the month of August, right? So the start of the last month was quite tepid, right? So mainly like it was a weak month for the market, and continuously we have seen the indices closing in the red. So mainly because at the earning of the start of the season, earning season itself, like there was a weak commentary from companies like TCS, and then it was followed by again like some bit of NPA worry expressed by Bajaj Finance, right? So mainly like that has led to some weakening of sentiment on the domestic side, and that has led to some bit of selling into the markets, which was again kind of accelerated by the FIA selling. So in the month of July, the FII has sold roughly around 47,000 crore of Indian equities. It was after a 5 or 6 months of continuous buying by the FIIs. So that has again led to some bit of sentiment breakdown there. And if you look at the crude also, so it has spiked sharply during the first half of the month, but again in the second half of the month it has come down, right? So mainly like there were two or three triggers, like weak commentaries by some of the large cap names, and then again like the tariff that was announced by Trump. So mainly like second half of the month, like it was imposed around 25% tariff on the Indian exports on to the US. So that has led to again some bit of weakening of the sentiment. So it was mostly like like all these factors that has led to some bit of selling into the market. But apart from it, the earnings coming from the mid and small cap names, right, that has been quite supportive, and we continue to see some double digit sort of growth coming from the mid and small cap side. Also, if you look at the SIP data that has come into the month, so that has shown a continuous uptick. In fact, for the June and July month, the SIP number has grown up by 24% from the February low. And the RBI has also front loaded the rate cut. So, like, in the first half of the year, the RBI has done around 1% of the rate cut and again injected close to 10 lakh crore of liquidity. So that has led to some bit of buoyancy in the system, and inflation continues to trade downwards. So mainly like the inflation figure currently at around 7 or 8 year low. So that has again provided some bit of room for the RBI to keep the stance accommodative and have more liquidity into the system. So all those sort of factors again have had some positive impact on the system, but mainly the weaker commentary in the first half and then tariff in the second half has led to some bit of selling into the markets. Now, if we just quickly look into the macro dashboard, so the month of July was impacted by the early the rainfalls, early monsoons that we have seen. So that has led to some bit of slowdown in the industrial production, or maybe some bit of slowdown on the steel production side. So mainly the infra-related themes and names were kind of impacted, and also we have seen what the commentary we have followed from some of the consumer discretionary names, right? So mainly the sales of the room ACs and the consumption items were kind of delayed because of the early monsoon. But apart from it, the PMI numbers, both in terms of manufacturing and services, continues to be buoyant. The consumer confidence remains to be on the higher side of it. And GST collection was typically we have seen a sequential decline in the month of June after a high of April and May. So that's kind of typical phenomena that we see in the second half of the quarter, right? So that we have experienced there. But overall, it was kind of a mixed picture. So we started on a strong note, but because of the early monsoon, some bit of activity got delayed or got postponed. So there was sort of mixed picture on the macro front. Now, coming to the domestic market performance side. So again, it was a month where the large caps were more impacted, mainly the large cap, mainly because the large cap companies have come out with the results, and the results were not in line for some of the companies like IT or let's say NBFCs. So there we have seen some bit of decline, which has led to the fall in the index around 2.9% for the month. However, the sentiment was kind of positive for the broader market, which for which the results have come in the second half of the month. The interesting thing to note here is that the index earnings has grown by around in the range of 5 to 15%, 5-6% for the large caps, and 12 to 15% for the mid and small caps for the last 1 year. However, if you look at the performance of indices, so the index is down around 0.7% for the large caps, and then around 4 to 6% for the mid and small caps. So indices have hardly made any money. So if we take into account the correction in the indices and the growth in the earnings, the valuation at current point of time is roughly it has cooled down by around 12 to 15% overall for the indices. Now coming to the sectoral front, so mainly it was again a month which was well impacted because of the news flow around the earnings season. So typically during the month, the IT was one of the sectors which was impacted. So IT was down around 9%. Uh, Again, the bearish commentary from some of the large cap names from the IT side. And then again, some bit of cautious commentary from the NBFCs and banking side. And there was again some bit of incremental spike in the NPA side. So that has led to, again, some bit of downward return in the banking names. Mostly the Pharma and the FMCG, which are kind of defensive names, have performed well during the month. So both Pharma and FMCG ended the month in the green. On a 1 year basis, so mainly sectors like IT, realty, and auto continues to downtrade, while sectors like pharma and banks have delivered the best of the returns, right? So banking index has performed very well in the first quarter, right? And again, because of all the announcements done by the RBI and the measures taken by the RBI, rate cut plus the liquidity injection. So it has led to some bit of positive sentiments around the banking name, and that's why we are seeing roughly around 9% return from the banking side for the month, for the quarter, for the year, sorry. Now coming to the global market performance. So India continues to be the laggard in terms of how the peers are performing. So we remain the only market, if we compare ourselves with the global markets, which has ended the 1 year on a negative side. Apart from us, US markets was also kind of underperforming till the first quarter end. But in the last 2 months, the US market has also picked up quite fast and quite well, as most of the trade sort of negotiations are taking place, and some bit of uh, confirmations are also coming around tariff side. So, but apart from it, be it Chinese market, German market, Brazilian market also, right? So all the markets have delivered very decent return. So it shows that whatever the excesses which were there in the system, mainly on terms of the excess valuation which was there for the Indian market versus the EM peer or the global peers also. So that has kind of nullified as of now, right? And the valuations are kind of attractive vis-a-vis global peers, and any sort of reversal in the trend in the market could be a trigger for the foreign players to come back to Indian markets and invest here. Now coming to the portfolio side, so we remain mostly allocated and towards the portfolio names. So the cash balance is on the lower side. So the cash balance which is reflecting for the IBL is mainly coming from the sale of one of the securities. So at the moment we don't hold much cash in the system. So most of it is completely deployed, and the kind of earnings that we are seeing for the portfolio company, so it's very encouraging for us, right? And there has been no as such big sort of earnings cut that any of the portfolio companies have seen. So most of it it's well invested and allocated towards the quality small and mid cap name into the portfolio side. Now coming to the tariff impact, so there has been 25% tariff that was which was there for the announced during the end of the month, right? And then again there was a penalty for importing the Russian crude. So again that penalty has come in at around 25%. So it takes the net sort of tariff rate for the India at around 50%. So what we have tried to figure out here is that the impact on the portfolio because of this incremental tariff, how it stands. So if you look at the smartphones are currently exempted. So mainly some things like electronics export or pharma exports are kind of exempted, and then services exports are also exempted from this 15% tariff, 50% tariff, and then some bit of section around, let's say, crude. So crude is also kind of exempted, and then other sort of items which we export to the US market. So only 5% of the Indian export goes to the US market, and of that, if you look at the share of the export that our portfolio companies have, so it's typically stands at around less than 2% for any of the portfolio. So it's not at all meaningful for us. Most of our the names that we are holding into the portfolio, it's mostly driven into invested into the domestic consumption side of it, right? For example, be it healthcare, like the hospitals that we own into the portfolios, or let's say the capital market themes that we are overweight on the portfolio side, or let's say manufacturing names that we are currently holding, or wires and cables names. So these are mostly the domestic driven stories and have very low export share, and the US export is again on the minimal side of it. Coming to the overall impact on the market. So again, the market we have already seen, we have released a note yesterday night also, that the impact of these tariffs on the markets will is expected to be on the minimal side. Although there could be some bit of sentimental impact that we are seeing from the FII selling, and also we are seeing some bit of weakening on the USD INR pair. So that could be the impact that the market has to go through. But overall, the Nifty earnings or the broader market earnings, so that will be very limited. Where the exposure is very limited there, so the impact will also be very limited in terms of direct correlation. Overall, we can take a hit of 0.6 to 0.8% downside because of this increased tariff if it's not negotiated and negotiated at a lower levels. Again, we have a 20-day, 1 days negotiation window, and then there are a bit of developments happening on that front. So we have to see how it pans out. So mostly the better way to be invested at this point of time is to be invested towards the domestic oriented themes, and that's how we have positioned our portfolios also. And government has a safeguard contingency fund. So basically they are expected to roll out policies shortly to make our export competitive, and to also safeguard the exporters, right, which are coming from, let's say, sectors like textiles or shrimp production, or let's say diamond and gold related products. So that's on the tariff side, right? We see minimal sort of impact, and whatever the impact which was out there, that has already happened, right? So we don't see any sort of material impact. Now coming to the markets, so mainly the markets have cooled down by 10 to 20%, right? This cool down we have seen on a 1 year basis uh, across indices is not showing the true picture, but most of the names if you look at, right, so there we are seeing some 10 to 20% healthy correction on a year basis, while the earnings has grown by 55 to 15%. So the valuations are kind of justified at this point of time. And considering we are a interest rate easing environment, US Fed, what the dot plot suggests is that US Fed is going to go for a rate cut, maybe in September with a 25 basis point. So considering we are in an interest rate easing environment, and it's a good trigger for markets to re-rate, right? So we can see some bit of the expansion in the valuations to come in over the next quarter or so. Earnings seasons is progressing well for the portfolio companies, and there is a broad-based recovery which is kind of visible. There was some bit of as I've already highlighted, some bit of negative news flow around the due to the early monsoon. Some of the consumer-oriented companies, especially in the room AC side and those front, so those companies are impacted. But early festive season could be a trigger for those companies to again liquidate the inventory which is already there in the system, and post a good year-on-year number. So themes such as domestic consumption, hospitals, financials, manufacturing, and China plus ones are expected to continue to do well in FY26. And what's actually supporting is actually supporting the market in this this period where FIs are continuously selling, is that we have a very strong SIP recovery that's coming in. In fact, at the yesterday the number has come in for the July month SIP, and it was at around 28,464 crore, which is again at an all-time high level. And we have seen the highest sort of inflow in the SIP coming in around the small cap funds, which is a growth of around 64% for the month-on-month number. Large caps, the SIP number has grown in around 33%, and for the mid caps around 38%. So it shows that then when the investors are putting their money where the earnings growth is, right? And that's why we are seeing the higher share of it going towards the small cap names. Again, one of the key thing to note here is that the FIA index short position is at around 92%. Last time it was at 92% or more than 90% around 3 years back, when there was Russia-Ukraine war in the middle of it, right? And post that, when when the short covering happened, we have seen a sharp rally in the market of around 10 to 15%. So any sort of good news on the market side could be a trigger for the market to rally in the short term. But again, there will be a lot of uncertainty around the global as well as the domestic side. So globally, there could be a changing geopolitical landscape. There could be further uncertainty around the tariff side or some cross-border developments, right, which has intensified after Operation Sindoor. So those sort of things can impart some bit of volatility to the market. While domestic volatility could be coming from something like slowdown in the consumption or weak quarter two earnings or annual volatility. So those are some of the key risks in the short term that we are currently monitoring. But we expect that the markets to be buoyant in the medium to long term. And any sort of positive news could be a trigger for the market to rally, because markets at current levels are clearly oversold. And it's just that the tariff has come in at a very bad time. So there is some bit of uncertainty around it. So the FIs are also continuously selling, and we have seen the selling to to have come into the month of August as well. So any sort of reversal there could be a trigger for the market to sustain and rally in the short period of time. So I think we remain cautiously optimistic on the market in the short term, and that's how we also go towards managing the portfolios. The earnings has been very encouraging for us, and we are very hopeful that as the earnings season will will be over, we'll be publishing the number for the quarter one, and it will be in line of 20-22% earnings growth for the quarter.